Hey, what's going on, everyone? This is Sam Kwak here. Welcome back to another Wednesday live Q&A on our Debt-Free Accelerator strategy. And welcome. It is September 11th, and it's a sad day, a tragic day for many Americans as well as people all around the world. And this is a day where almost 18 years ago, 18 years ago, people went to work with hopes and dreams, and they never got to fulfill them because the tragic. And so, it's a day to remember the tragedy, day to remember what has happened, and also a day to remember to recognize the bravery and the heroic action of our quick action emergency services in New York. And I know there are many firefighters as well as emergency services that weren't from New York that drove all the way to New York City to help and recover the damage and rescue people that were still alive and stuck underneath the wreckage and the rubbish of the towers being destroyed. So we want to recognize those heroes, and if you or your family have been impacted or have been involved in the 9/11 terror attack, we stand up to you. We give you an appreciative bow, and if you are a firefighter watching this, hey, thanks for protecting our neighborhood. Thanks for watching our back, and I really appreciate all of you guys. And it's a day to remember. So going on our program, I appreciate you guys getting on board. And I know we're a little early. We're about 5 minutes early into the game, but I wanted to. We had a lot of people watching or waiting on standby, so I wanted to ask you guys to welcome and ask you guys where you guys are from, and we'll get a little head start on asking questions. So we got Jose Pina. Hi, good morning from California. I think it's Jose Pina. If I got that wrong, I apologize. Ann Lamb is saying hello. Can't hear audio for some reason. You may want to check your you may want to check your computer because I got audio on even on my own phone. So you may want to check on that. So yeah, guys, I see you guys from California. I see. We're here in Illinois, right? Go and comment down below. Where are you guys from? We'd love to welcome you to the Kwak Brothers show. If this is your first time being here, this is a time where we answer your questions live. And I got my phone here. I almost said computer. Well, it essentially is a computer in a way. I got my phone here, and I'm looking at all the questions that are coming in, and I'm going to be addressing the questions that you have about. Whether it's about your home equity line of credit, it's about paying off your mortgage. We'll cover a little bit about real estate investing. Audio is good now. Awesome, fantastic. So if you have questions about a certain debt situation that you may have, this is a time for you guys to go and ask your questions, and I'd be more than happy to answer. Ann Lamb is saying, I'm from San Carlos, California. Well, welcome all the way from California. Amazing. I know it's 8:57 there, so it's bright and early morning. Amazing. We got three more minutes until we officially start the show. We're going to go and welcome everybody. If you are watching this and if you're hearing my voice as I'm speaking, go and comment down below. Where are you guys from? We'd love to learn and welcome you guys into the show. Okay. Samuel Ziegler is already asking a question. Do you recommend the infinite banking concept with real estate? So we're going to actually cover that in just a sec. Let's go and wait until the actual show. So stick around and I'll go ahead and answer that question. We got Jose Pina is saying, hey, I'm from Central Valley, Fresno area. Welcome. Watching from Houston. And Marcel Galiga is asking, what if you have a new home without lots of equity? So I'll definitely cover that when we actually go and start the show. We'll get those questions out of the way. Okay. All right. Awesome, guys. And for those who, unfortunately, who couldn't get the audio of what I said earlier, it is 9/11, September 11th, and 18 years ago. Here comes Chris. 18 years ago, we had this tragedy that happened. I remember 18 years ago, I was in second grade elementary school. So if that makes you feel old, I apologize. But I remember being in second grade. All of a sudden this announcement came from the PA, from the intercom, and they'd said something about big thing happened. Bombing happened in New York, and All I remember was we were sent home early that day because everything just kind of shut. Everything just shut down. All the schools, all the airports, all the mass transportation stations and network were shut down. And all I remember, I came home watching. I saw my dad with the TV on in the news, and all I see is an airplane hitting a tower. Of course, at the time, I didn't know what a World Trade Center was. I was a second grade, and what did I know? That's all I remember. And then the next day was never the same. The day after September 11th was not the same in America as September 10th. And that's all I remember. And ever since then, we saw this war on terror that we launched. A lot of crazy things happened ever since, and what a tragedy. So we got Theodore Bernard is saying, hey, another Fresno resident watching. Welcome from all the way from California. We got Wilmington, North Carolina, April Evans. Welcome, April. We got Jerry Baltimore from DMW, which is, I believe, DC, North Virginia, Maryland and Virginia. I think that's, the tri-area. So welcome, Jerry. Welcome. Awesome. All right, so it is 11 o'clock Central Time, right on the dot. So let's go and get the show going. So welcome again for you guys watching this live Q&A Wednesday morning, 11 o'clock Central. And we already have some questions. This is amazing. This has not happened before. So we'll go right ahead and kick off answering question. I do have something to talk about today, which is going to be on the debt consolidation, which last week I talked about it. I finally brought my piece of evidence, so we'll go and talk about that. We're also going to talk about does interest rate matter and why it doesn't? And I know a lot of you guys been commenting on our videos saying, well, aren't HELOCs have higher interest rates? Don't they have variable rates? Don't they have wouldn't the bank just jack up the interest rate one day? Well, we're going to talk about that in just a second. But before I do, I want to actually talk about one of our sponsors, which is our amazing real estate software, PropStream. So for those who are watching this and you guys are interested in real estate investing and you are looking for deals, right? You're going out there looking for owners. You're looking for properties that are highly motivated, highly distressed. Well, fear not, there is a solution. PropStream is an amazing software company that we got to partner up with. They help you find off-market deals. They help you skip trace, meaning you can find out who the owner of a property is and their contact information. PropStream also uses the MLS technology to help you give you comparables and also get an estimate of what the property is going to be worth. And also has an amazing marketing engine where you can send out postcards, you can send out letters, and contact the owners directly. So my listeners and people watching this right now can get a free 7-day trial. All you have to do is go to reisoftware.thekwakbrothers.com. That is reisoftware.thekwakbrothers.com. You guys get 7-day free trial with the software, and you guys will be literally blown away. The other day, I had Daniel try this software, and he was looking for deals, as I was. And Daniel was literally blown away. He was like, "This is the best thing since sliced bread." Okay, and that's a lot coming from Daniel. So go and definitely check out the free software, 7-day trial software. And after 7 days, it is only $97 a month. Trust me, it's totally worth. Even if you do just one deal a month using the software, it would definitely pay for it. So go and check out the 7-day free trial. All right. So let's go ahead and get some questions answered. I know I see questions already, which is phenomenal. I appreciate you guys doing so. Let's go and tackle Samuel's question. Samuel Ziegler, do you recommend the infinite banking concept with real estate? Yes, absolutely. And now, again, this is not directed at you, Samuel. This is directed for everybody. And this may also depend on your long-term financial goals. So for those who don't know what infinite banking strategy is, you might be totally tuned out because you're like, what is this thing? Infinite banking strategy includes using a whole life insurance, or in this case, a universal index life insurance policy to basically bank on yourself. So if I'm going to give you a very layman's term, essentially you're turning your life insurance into your own bank. So you're banking on yourself, you're treating your life insurance as a bank, and the interest that you pay back to your life insurance essentially is an interest that's accumulated to your cash value. So instead of forking over a large amount of interest over to the banks, you're now accumulating interest, you're earning interest from your own real estate transactions. So I have a good buddy of mine, I won't disclose the name in the show, but he put in $200,000 cash into his life insurance policy. He can borrow against his life insurance policy anytime he wants, and he can take that money and do a real estate deal, pay himself back, with 8%, 10% interest, and essentially his life insurance is accumulating all this interest, and he's by himself doing this, he can accumulate a lot of cash in his life insurance, in his cash value. So he never has to raise money. He never has to go through a hard money lender. He never has to go get a loan to do a real estate project, which is pretty darn good. So infinite banking concept can definitely be a useful strategy, especially if you want to create that wealth on your own instead of giving that interest away to the banks. Okay, but again, depends heavily on what is your long-term goal, right? What is your long-term financial goal? Is it to create cash flow? Is it to create a cumulative cash deposit? It comes down to what your goals and needs are, okay? All right. Marcel's question is, what if you have a new home without lots of equity? So I'm guessing the question is in the context of using our strategy, right? Like if you want to get a HELOC, if you want to get a home equity line of credit, but you can't, and you can't because a lack of equity, keep in mind there are other tools such as a personal line of credit to be able to use it on this strategy. So don't give up hopes when you don't have much equity. You can still use an unsecured personal line of credit. Now, the argument is, well, the personal line of credit has a higher interest rate, which we'll get to that in just a sec, and I'm gonna explain to you guys why the interest rate does not matter. And I really want you guys to drill that into your head. Interest rate does not matter when used in the context of our strategy, the debt-free acceleration strategy. So you can use stuff like personal line of credit, business line of credit if you're looking to pay off your business loan. Very rarely, if you have to do this option, then I would go with even just credit cards to use this strategy, okay? Alrighty, we got Francisco Santana from Arizona. Welcome, Francisco. We got Steve Fernandez all the way from LA. I was just there a couple weeks ago. Yes, and please make sure you guys like and subscribe to our channel. Appreciate a lot. It gives us support. It really gives our channel the boost that we really need to get the message out there. So appreciate you guys doing that. Okay. Okay, Samuel Ziegler is following up onto his question. He's saying, actually, it's for participating mutual whole life insurance. So for us here in the Kwak Brothers, what we teach is using universal life index policies. So maybe a different product, but one thing from my understanding, the reason why we go for universal life index is because it's indexed based on what the market is doing, and the interest rate is higher. So we actually may bring in an expert to talk about this. Personally, I'm not the foremost expert in different products for life insurance, but I can tell you the concept of why and how we need to use a universal life index policy to do how that adds into your real estate investing strategy. Okay. Francisco Santana is asking, I've never heard of infinite banking. That's brilliant. I had to consider it as a tool for investing. Yeah, it could be a great thing. In fact, this is actually a variation of what the Rockefeller family is doing. If you guys know, or if you guys don't know who the Rockefeller family is, they got very wealthy in the early and late industrial revolution by having an oil business. So Rockefellers are a very, very wealthy family, and this is a variation of what they do to maintain and keep their wealth even throughout the generation. Okay. Alrighty, let's see. Francisco Santana, again, is asking, we have a relatively low HELOC limit. What's the best approach? Pay off mortgage faster or invest in new property? So we actually have a video segment on this. Do you pay off your mortgage faster, or do you focus on paying off your mortgage, or do you invest in more property? So there's two schools of thoughts with this answer. I'm gonna give it to you guys in order. The first school of thought is you choose one. And the reason why you want to choose one is it depends on what the market cycle is doing. So for example, right now, I believe we're at the height of the market. In fact, I feel like we're starting to cool off a little bit, but it could just be a seasonality thing. But when the market's doing really, really well, the interest is really high in terms of paying you guys, whether it's bond or whether it's stocks, stocks are doing really, really well. When the returns are really high, the economy is doing really, really, really well. This is actually a great time to start paying off your debt and start consolidating some cash. if you see what these big banks are doing, they're accumulating a large amount of cash, because usually what typically happens after an economic boom is what? An economic recession, right? The market goes down. So for the past 100 plus years, the United States, we've been living off of an economic cycle. We've been doing this boom and this crash over and over and over again. So what you want to do is you sort of want to be smart and wise about what you do with your finances. When the times are good, you don't splurge and go and spend and waste money. You try to save up. You try to eliminate as much debt as possible. Save up cash, stay liquid, and invest in short-term investments. Now, when it comes to an economic crash, when there's a recession, when assets are cheaper to acquire, that's when you go in and expand and buy and just expand, right? Expand your territory. So my thought right now is, if you want the simple answer, and I'll give you the second school answer next. If you want the simple answer, right now it's better to focus on paying off your debt first. Now, this doesn't mean that you shouldn't invest at all. I think there should be some level of investing going on, but generally, what I'm leaning towards is paying off your debt, stay liquid, get as much cash as possible. Now, again, that doesn't eliminate the fact that you do still need to invest, and there needs to be still investing activity when the opportunity presents, right? That's my school of thought, the first school of thought. The second school of thought is you can do both. Now, the reason why I can say both is you can pay off your debt using your own money, using the HELOC strategy. It's really good strategy. But you can also invest and acquire properties using instruments and tools that are not contingent on you paying off your debt, or whatever that doesn't provide a distraction for what you're doing on the paying off the debt side. So here's what I mean, and I'll break it down for you guys. If you're paying off your debt, you're using your own money, you're using your own income, right? And you don't necessarily want to take any extra income away from that goal, because obviously there's a conflict there, right? You can either take your income and savings and pay off your debt, or you can take your savings and money and invest. So there's a conflict. You can, it almost sounds like you can do one or the other. But the strategy that I'm going to show you guys, you can actually do both. So you're going to take all of your own cash, your own income, your own personal finances, attack your debt. You can also use other people's money, get a partner involved or a lender involved to keep on investing using other people's money. So it doesn't really distract you from paying off your debt, okay? Unless it's gonna take away time or focus and energy. But if you're in a position where you can do both, you could do both using other people's money and also negotiating for owner financing. Now, of course, for those who don't know what owner financing is a simple concept where you and a owner of a property create an arrangement where essentially you get the ownership of the property, but instead of doing a lump sum cash, you're paying the owner, or now the seller, a small monthly installment payment every single month, sort of like rent-to-own situation, but you're actually building equity. You're sort of paying over time to get an equity position in this said property. So what that does for you guys is it eliminates having to go through a bank loan. It eliminates having to get your credit checked. It eliminates the fact that you even have to have a relationship with the bank in the first place. So owner financing is a great way to sort of bypass the need for credit, or if you have credit down the toilet, this is a great way to sort of get around that. And using other people's money, raising capital, so to speak, now eliminates having you from using your own cash or your own savings to invest. So you can sort of do both at the same time, but again, it depends on how much time and energy can you really devote to doing both, okay? All right, let's see where we're at. Okay, Steve Fernandez is asking, I did a VA loan at $450,000 for 30-year amortization, just closed, but realized I should have done a HELOC. Can I still do a HELOC? I only have $51,000 left in equity. House is appraised at $510,000. So there's, again, my two schools of thoughts. There's always two schools of thoughts in everything in life, or maybe more. So here's what we need to be careful, and I'm going to answer this question with a little bit of a caveat. You can go get a HELOC on that whatever appreciation you capture, meaning between the time that you got your VA loan and the time that it was appraised. I don't know what the time span there is, but you can go get a HELOC on the difference. You can go get a HELOC on that equity that you built. However, the caveat is you have to understand, is that appreciation a real appreciation? Now, what I mean by real appreciation is the appreciation based on natural growth, or is the appreciation based on the hype? And the natural growth I'm talking about, is there a demand, like a real demand in your market? Are people actually wanting to buy homes and they're moving into this neighborhood? There's new developments happening everywhere around. Is there a natural growth for that place? Or is it because people that weren't thinking about buying homes are now thinking about buying homes because the interest rate dropped, or it's easier to get a loan? Is it easier to get financing? So you have to sort of weigh that out, because if it's the latter, where people who weren't thinking about buying a home are now thinking about buying a home because of how easy the financing is, that could be dangerous, because now it's based on appreciation. It's based on phantom, artificial appreciation, right? There really isn't much growth in that market, but it's the same people that were there already that are just going to go get a loan because it's easy to do it. And that creates what's called phantom appreciation. So you have to be careful. If it's phantom appreciation, you may not want to get a HELOC, because let's say there's a market crash or a recession down the road. Well, when that artificial appreciation dries up, when it goes away, your home value is going to drop, right? And when that drops, you don't want to be holding the hot potato when it explodes on you, when you owe more than what your home is worth. So this is a classic case of a home being underwater, where you owe more money to the bank than what your home is actually worth. So this is why most undereducated individuals in the financial realm get in trouble, because they don't understand and they don't really have this way of judging, is this an appreciation that's based on natural growth, natural demand, or is this appreciation based on hype and easy financing, easier monetary policy? So you really have to make that judgment call and really get an idea. This is where market analysis is huge, right? If you don't know your market, this is the type of mistakes that you can make. So that's something that you need to judge on your own, Steve, is my area, is where my house located, are we actually appreciating the natural appreciation, or is this just all hype because financing is easier? Now, an alternative is a unsecured personal line of credit, where it's not necessarily tied to your equity, and it's not a lien against your home. So an unsecured personal line of credit can actually be an alternative, sort of as a way to protect yourself from losing your property based on the consequences of a recession, okay? All right, Francisco Santana. Universal index policies are better in general than whole life policies. Yes, thank you so much for clearing that up. Appreciate that. Carmen Lopez from Seattle, Washington. Hey, welcome. Could you explain process to buy a second home using the HELOC? Thank you. So, Carmen, before I get to the technicality of buying a home or any home with a home equity line of credit, we first have to ask ourselves, what is the justification of you wanting to buy a second home? Is it because you want to rent it out and create cash flow, or do you want to just have a second home for the sake of having a second home? Now, I'm gonna put a different hat on, which is my philosophy of money management hat, or I should say, smart investing tactic hat on. If you're just buying a home to buy a home out of just wanting to have a second home, and it's not doing much to help you create income, my answer for that, or my philosophy, is don't do it. Now, the reason why I say that is because you're getting in more debt for just luxury purposes, right? But if your reasoning, if your purpose of buying a second home, quote unquote home, is to turn it into a rental property, or you're looking to turn it into an Airbnb, or something to do with generating income, I'd say, you know what, that might be something that you could consider doing, because on the basis of you're making money with the HELOC. But if you're getting yourself into more debt for the sake of getting into more debt, probably not. This is where I actually agree with Dave Ramsey, where Dave Ramsey says, don't go and get your HELOC to buy a home, or buy another car, or buy a motorboat, or to go fund a vacation. Yeah, it's a really dumb idea. I think it's stupid, and I'll say that word. That's where I agree with Dave Ramsey. Where I don't agree with Dave Ramsey is actually using these types of financial tools to actually go and acquire income-producing asset. That's where I disagree with Dave Ramsey. Dave Ramsey says, hey, stay away from debt as far as possible. And I know where he's coming from, because he had a trauma. He had a huge bankruptcy issue when he was 28, 29 years old. He was in a financial deep trouble. So I can see where he's coming from. But that's because he sort of flew an airplane without a license and without proper training, and he crashed and burned. And it's really, it comes down to his responsibility to learn, right? But if you are wise with these types of tools, HELOCs, HELOans, whatever, credit cards, then you can go really far in life and be successful in finances without sort of the negative consequences. So the key here, the key takeaway here is get educated on these tools, learn about what these tools can do and cannot do, and the consequences of using these tools in a really, really bad way. So getting educated, being aware, being financial literate is gonna help you and go a long way. Now, to come back to your question, if it's a rental property, that's something that you can consider doing, depending on what the return is and what you can expect out of it. If it's to buy a second home for the sake of having a second home, my inclination is to say no. Okay. All right. Ann Lamb is, I didn't understand the HELOC strategy until watched your video. You broke it down step by step. I've been using it and my mortgage has decreased dramatically. I have a $500,000 limit HELOC. Well, that's amazing. Congratulations. I really, I'm glad, and from the deepest part of my heart, I'm really glad that you got to use the strategy. And I'm glad to see that you got to see the transformation that you're seeing. Cool. Let's see. Learning the strategy has gotten me hooked on learning a new strategy and accelerated my journey to F.I. I'm not sure what the F.I. stands for, but must be a really great thing. Focus on HELOC with a bad credit, really? Thanks for answering my question. I'm not sure what this person's asking, but I'll go and ask the next question here, or answer the next question here. Dennis is saying, hey, what's up from Milwaukee, signing in. Welcome in, Dennis. Awesome. So I'm gonna get to the topic where we're gonna talk about the debt consolidation that I got my thing here, and I'm gonna tell you guys, if you ever get these, and you can see that I redacted all the private information, of course, apart from my own home address here, but I'm gonna talk about this just in a sec. But first, let's go and talk about, I'm gonna give it to Chris so you can see it. There you go. Hopefully you guys don't see my home address there, but so if you guys get one of those letters, we're gonna talk about that in just a sec. But first, I wanna talk about our upcoming event, the Market Domination Mastermind event happening in October 4th and 5th. So if you're wondering, I wanna get into real estate investing. I wanna buy rental properties. I wanna fix and flip houses. I wanna wholesale real estate, but you're struggling because you don't have the capital, you don't have a mentor, you don't have the knowledge, you don't have the capital, the credit, whatever the case might be, whatever you're struggling at, then you need to come to this event. So on October 4th and 5th, Daniel and I are co-hosting an amazing retreat. It's gonna be amazing. There's gonna be an awakening. You guys are gonna start speaking in tongues, because that's how much spiritual power is gonna come out of this event. Anyhow, on October 4th and 5th in Dallas, Texas, come join us for a 2-day retreat where Daniel and I are gonna do a never done training called the F.O.R.C.E strategy training. You guys have to definitely be there. We got some really great guest speakers. If you guys know who Caleb Maddox is, he's gonna be there to speak. The young kid that does really good motivation speaking, he's gonna be there. Bryce McKinley is gonna be there. Nadine Mazzarelli. We're gonna have Jerome Maldonado, who is a commercial real estate expert. So we're gonna have a buffet of all sorts of different real estate investing strategies that are gonna be talked about. You need to be there. So you can buy tickets right now for low as $99. Our listeners, you guys are gonna get a complimentary vacation giveaway as well, provided by one of our sponsors. So go to marketdominationmastermind.com. That's marketdominationmastermind.com. Get your tickets, guys, today. Hotels are booking up really, really quickly. There's only actually 2 rooms left at the hotel where we're doing the retreat. So chances are you don't want to miss out. And we're going to get lots of tickets sold. Lots of people are going to be there. Network with us, meet us in person, hug me, whatever you want to do. Take a picture. I'm going to be there. So definitely be there. Get your tickets today, and you will not regret it. Okay, let's go and talk about the debt consolidation letter. So chances are you guys get this a lot from different companies. Now, I'm gonna read this to you guys, and I know Chris had it pointed out earlier, but I'm gonna read this to you guys because it's really interesting. And I'm gonna tell you guys why this is misleading in the context of using our strategy. So it says, hey, dear Samuel Kwak, that's actually my full name. Right now, you may be buried under a mountain of high interest credit card debt and crushing monthly payments, but we can help you fix it that once and for all. Like they have a wand, right? They have a special spell that they can get your debt disappearing. You have been pre-approved for a debt consolidation loan of up to $35,000 with an annual percentage rate as low as 3.87%. Ooh. Just compare that with a bargain rate to a sky-high interest rate you're currently paying on your credit card balance every month. The difference will shock you. I'm already shocked. To take advantage of this amazing offer, call toll-free, and I redacted that number. So here's your justification. There's a little chart here. I know you guys can't see it, but there's a comparison between if you use their service versus what I'm expecting, what I have expected. Apparently they know my interest rate for my credit card, which is not right. But so they have two charts. They have monthly payment of $561 and a monthly payment of $137. And they're saying that the consequences of using their service to consolidate the debt is going to lower their monthly payment. Now, this is where it gets really misleading. This is kind of like a trap door that these companies are setting up for you guys. Now, the 3.87% interest rate sounds really, really, really good. And this is where I have a problem with this. Yeah, the monthly payment's low. Yeah, the interest rate's low. But here's the problem. It says your first year saving is $5,083 based on their calculation. Now, my question is, well, is it though? Like, are you actually saving the $5,083? It may seem like you're saving $5,083, but what this advertising doesn't talk about is what is the total amount of interest that you're actually gonna pay, not the monthly payment that you're gonna pay. Okay, there's a huge difference there, guys. Your monthly payment could be really, really high, right? Really, really high, but bulk of that could be going to the interest or the principal, which actually pays off your debt, right? But what these guys are talking about is your monthly payment. And so let me illustrate this. Let me illustrate it to you guys this way. I'm gonna make this really simple. So let's say you all are paying $500 every month, okay? You're paying $500 every month, and this letter, this advertising is saying, I only have to pay $137 a month. But what if I said to you, the follow-up information that I gave you guys was the $500, 90% of that is going to principal. But the $137, what if I said 90% of that is actually going towards interest? So you guys see the difference here? It's not about the monthly payment in this case. They're totally misleading people thinking that they're saving money just because the monthly payments are low. This is how car dealerships get away with ripping people off, because they make you focus on the monthly payments, not on the actual payment, the principal balance of it and the price of the car. Okay? I know you guys if you guys been to car shopping before, you guys know exactly what I'm talking about. The car dealer sales guy comes say, hey, he draws the four squares right in front of you and says, hey, what do we need to do to lower if we lower the monthly payment for you guys, would you take the car today, right? That's the question that they ask all the time, because they want you to focus on the monthly payment, because most people think, because they're not financially smart, most people think that that's where they're gonna get their savings. But little do they know that they're jacking up the interest rate, or they're jacking up the principal balance to get the money, to get the margin. Or they might say, well, sir or ma'am, we're gonna give you 0% interest rate, and we're gonna try to lower the monthly payment as much as possible. Okay? They may tell you, hey, let's give you a $100 discount on your monthly payment. But little do they know, they're gonna tack on $10,000 on top of the price on the car. So this is exactly what they're doing. Same exact spiel, the type of tactic that the car dealerships use is they trick you thinking that you're actually saving money based on the monthly payment, not on the actual interest that you're gonna pay on the total life of the loan. Now, the second part that they're tricking you here is the interest rate. So they're giving you a comparison of a credit card interest rate of 19.9%, says on the letter, and what they're charging for interest rate is 3.87%. Now, majority of you guys watching this, or some of you guys who may not be familiar with our strategy and our philosophy, may think that, hey, 3.87% is actually really, really good. Like, that sounds amazing. Now, here's where the trap door is with this, if you guys understand how interest rates work. So credit cards, which is an open revolving line of credit, credit cards use what's called simple interest, or some banks may use average daily interest or average daily balance. So the way that the interest rate on your credit card is calculated differently than what an amortized debt is. So what they're offering here, the consolidated debt consolidation loan here, is offering an amortized debt, very similar to your mortgage where you have a fixed amount of months or years that you have to pay off the loan. So in this case, I think this is 60 months, 5 years. Doesn't say, but let's say it's 5 years, right? 60 months. In that 60 months, you're fixed with a schedule, right? Every month you have to pay this for 60 months until it's fully paid off. Now, here's where I'm gonna give you a really good comparison, a really good analogy. So let me ask you guys this, and you guys can answer this down below in the comment section. What is hotter? And I'm talking about temperature. So what is hotter in terms of temperature? 32 degrees Fahrenheit or 1 degree Celsius? Okay, for those who pay attention in 7th grade science, you guys know the answer, right? 32 degrees Fahrenheit versus 1 degree Celsius, what is hotter? And of course, just looking at the numbers, like, well, 32 is a lot more than 1, so it must be 32. Well, guys, Fahrenheit and Celsius uses different type of metrics. It uses different types of measurements to measure heat. So what I'm getting at is that obviously, for those who know, 1 degree Celsius is much hotter than 32 degrees Fahrenheit. Well, it's kind of the same sort of analogy that I'm pointing out here with the interest rate. Just because that 3.87% sounds sweet and amazing, doesn't mean that it's gonna save you more money than your 19.9% interest, because the credit card and the line of credit interest rate is calculated differently than an amortized interest rate. Okay, amortized loan, again, guys, for those who don't know, is front-loaded interest, meaning your initial payments, when you start using the service, your first half of the payment schedule, majority of your payment is gonna go towards interest, and you're actually gonna end up paying close to double the amount of what you borrowed using the debt consolidation loan. Now, if you're using our strategy, that 19.9% interest rate should not scare you. It should not worry you at all, because if your focus on our strategy, on the debt-free acceleration strategy, is not on the interest rate, okay? But it's on the average daily balance. It's focused on the principal balance that we need to destroy principal balance, because that's what, at the end of the day, kills the interest. Interest rates do not have power, okay? You do not give interest rate power unless the principal. So let me backtrack and break it down to you a little bit better. Interest rates don't have power, okay, if you don't have a high principal balance. If you have high principal balance, and if that's not what you're focused on, then yeah, you should be worried about interest rate. But if you pay off your principal balance faster than what your interest rate can catch up, you're gonna get a faster saving, a better saving to add than your 3.87%. Now, I know some of you guys don't get it because we've been so drilled down to think, oh my gosh, interest rate's higher on a line of credit on a simple interest than an amortized interest of 3.87%. I know a lot of you guys are drilled that way. So I know this is gonna be a huge shift from what you've used to learn, what you've used to think as far as interest rates go. But we have to wake up. We have to realize that this is a trap door, okay? Because the way the interest rate is calculated, the way that interest is calculated on a line of credit is completely different than how the interest is calculated on amortized debt. So, my theory, or at least my philosophy, is that I believe that the banks have been sort of tricking us, and I know tricking might be a sort of a weird word for this, but I just feel like the banks have been tricking us to think that interest rate is the end all be all when it's not. Okay, interest rate is not the end all be all. It doesn't tell the whole entire story. Because if I, let's say, have 10% interest rate on a $10 principal balance versus a 1% interest rate on a $100 balance, obviously the 10% interest rate is gonna yield a lower interest amount. That's what I'm getting at. Okay. All right. That was a little circle that we went in there. So I hope this gives you guys a sort of or at least gets you guys starting to think, okay, interest rates are not created equal. Okay, a HELOC interest rate and an amortized loan interest rate are not the same thing. Okay, I know you might think math is math, but how the balance is factored into the interest rate is different than your amortized debt. Okay. Let's see. Dennis is saying, when is the training going to be in Chicago? So Dennis, we have a bi-weekly meetup every other Saturday. So if you don't know, go to our website, thekwakbrothers.com, click on events, and you're gonna see all the events that we do here in Chicago every other Saturday. Francisco Santana is asking, what are your thoughts on using rewards credit cards for all expenses and paying them off right away with HELOC and then paying down the HELOC as usual? So Francisco, you're actually using a variation of a strategy that our students use to not only have 0% interest on their purchases every month, but also it consolidates all the expenses into one using the HELOC. So yeah, what you're getting at is actually what a lot of our students use to optimize and maximize interest savings. So you're actually onto something and it's really good. Okay. Randolph Leffridge is saying, what's up, Sam and Dan? Hey, what's going on, Randy? How's it going? Marcel is asking, is it a smart idea to use savings to pay down and force equity that could be then used to pay down high interest credit cards? So one thing that you can do, actually, this is something that I do in our business at least, is we do all of our expenses, we do all of our expenditures out of our credit cards. I wish I had my credit card with me here, but we do all of our expenditures on our credit card, and what we do is we take our business line of credit, pay off the credit card, and then we take all of our business income and throw it on the business line of credit. So I don't know if that's what you were referring to, but that's what we do. And of course, there are months, where we don't have any debt because we just have lots of savings going on. That's usually what we do. So we actually use credit card even if we have enough cash to pay for it, because we want to take advantage of the rewards and the points that we get. And it's crazy because every 2-3 months, I qualify for a free vacation or free travel because the amount of points that I stack up, even if I have cash to pay for it. So that's why I love credit cards, because I get to earn points and I just pay the credit card right off, with the cash that I have. So that's a way to sort of credit card hack, if you will. Okay. Let's see. Is there a different types of HELOCs? Someone mentioned to me interest only is the best deal. So yeah, there are actually different types of HELOCs out there. There are principal and interest payment HELOCs. Majority of HELOCs that you'll find that are offered by different banks are going to be interest only. Now, the reason why someone may say, well, interest only is better, because it gives you that flexibility of, let's say you run into a really bad month, or you run into a month that your income isn't quite there, especially true for business owners out there. You have that option to sort of default back to the interest-only option. Now, the downside obviously is if you don't actually pay beyond your interest-only portion, if you don't actually pay your principal, then you're gonna be trapped, and this is where Dave Ramsey would say, yeah, that's very dangerous. So that's the downside with a HELOC that has interest-only side of things, is if you're not disciplined or if you're not focused on paying off the HELOC, then you can get into some serious trouble, okay? Marcel is paying down mortgage. Yeah, so you can actually use a credit card instead of a HELOC to pay off your mortgage. It's not preferred, it's not the best way possible, but yes, it can be done. It still bears interest savings and time saving as well, okay? All right. So it is 11:37. Been such a great show so far. We're gonna continue, but first, before we get to the next question, or we get to whatever question that we're gonna tackle next, we want to first talk about a free course, the free course that we're offering to you guys. So if you guys are interested in buying properties using owner financing, which is something that we talked about earlier, not having to use your credit, not having to use a bank, then chances are you are interested in learning how to negotiate for owner financing. So my listeners right now, you guys qualify for our free course that you guys can sign up. No catches. We're not gonna ask you for your credit card information. This isn't a trial. You guys get to keep this course for free for lifetime access. So go and get your free access to our owner financing course, where Daniel is gonna teach you how to negotiate for owner financing, what questions to ask, what questions to avoid, what sort of pitfalls to avoid when negotiating for owner financing. So you guys can go and sign up for this free course right now. At this very given moment, go to freeownerfinancingcourse.com. Again, that's freeownerfinancingcourse.com. You should be able to see it right here on the screen, or is it this way? Yeah, this way. Go and sign up for that course right now. It's completely free. You guys will learn a lot from Daniel on how to negotiate for owner financing. Okay. So I don't see any other questions, but we can go ahead and keep on talking about this whole debt consolidation thing, which you guys get these types of letters a lot. Now, I have to say that there is a time and place for these types of products out there. I'm not completely painting these types of company as evil schemes or evil entity, but there's a time and place for these types of debt consolidation loans. Now, one thing that I see that's really good about debt consolidation loan, which you do actually end up paying more interest over time if you're not using our strategy. But one thing that is good with debt consolidation loan is that if you have high usage on your credit, or if you have high utilization rate as far as your revolving lines of credit, such as credit cards or any types of line of credit, then a debt consolidation loan can help you sort of take away the debt balance that counts towards your utilization rate. And here's what I mean. Your utilization rate is a big factor when it comes to calculating your FICO score. So your FICO score, 30% of your FICO score, your credit score, it comes from your usage, your utilization rate. So utilization rate is calculated only on revolving lines of credit. Let's say you have a $10,000 credit card, okay? And you use $3,000 of that $10,000 credit card limit. You have 30% utilization rate given the assumption that that's the only credit card that you have. So if you only have one credit card, $10,000 credit card, and you use $3,000 of it, you have 30% utilization rate. Now, if you have two credit cards that has $10,000 and $10,000 each, and if you use $3,000 on one credit card and the other credit card is completely empty, you have 15% utilization rate because now you have more limit but the same balance. So ideally, you don't want to go past 30% utilization rate. When you use more than 30% of your total revolving credit cards, it can start to damage your credit a little bit. It may start to hurt your credit score. So where the debt consolidation loan is helpful is that if you consolidate all your credit card debt into an installment loan, your installment loan doesn't count towards the utilization rate. It doesn't count towards the percentage that I just talked about. The downside, the consequences is now you have a new credit file, or you have your overall age of credit goes down. So that's the only downside, but the upside is bigger because your utilization rate goes down. It can help you actually improve your credit score temporarily. Now, of course, doing this, again, just like what I iterated earlier, is you may actually end up paying more interest if you're not using our strategy, okay? All right. Okay, so I don't see any other questions. Yeah, Dennis, please come over to our Chicago meetups. We would definitely welcome you to come and check us out, okay? Alrighty. All right, guys, so by the way, if you have checked out our HELOC strategy, if you love our HELOC strategy, and you're wondering where can I get my calculation done, you guys can go get a free calculator. I know it's not down below anywhere, or we don't have a sponsor card for this, but if you go to debtfreeaccelerator.com, you guys can get a free calculator as well as an ebook that explains more about how our strategy works. Another thing is, you can also download this calculator, which we also have an online version. If you have the new iPhone 11, okay, because I don't use an iPhone. If you have the all-new iPhone 11, apparently you can get a better experience using our calculator. So go get your iPhone 11, I guess. I've been a proud member of Samsung Club since 2007. So I do not betray my motherland. I'll just put it that way, okay? Once a Korean, always a Korean. By the way, if you are a Korean listening to this, okay, and if you dare to use an iPhone, okay, how dare you use, no, I'm just kidding. Here's a fun fact, and I'll go into my geek mode in just a sec. Did you know that the chip, the microchip that goes into your iPhone, okay, the processor, is actually made by Samsung? Okay, didn't come from me. Okay, so if you buy an iPhone thinking, oh my gosh, my iPhone's so precious, well, just remember that the microchip inside your iPhone is made by Samsung. Okay, all of you guys are like, why did I buy an iPhone then? That's right, you bet. Now I'm giving you all the guilt that you need to deserve. So next time you consider buying a phone, maybe you can buy an iPhone 11, or you can just buy a Samsung S10 like this guy did, and enjoy all the same processing power and even more features than an iPhone. Okay, this is where Samsung needs to cut me a check for 10 grand for the brief sponsor there. So guys, I enjoyed your guys' question. I really do. Oh, we got Bobby Simpson here. It says, Bobby Simpson says, hi Sam, you said before to keep your utilization rate at or below 30%. So if it was to get a $150,000 HELOC, should I chunk $50,000 towards my mortgage, or should I do smaller chunks? So this all comes down to what is your priority. And I think I've said this before in my live shows before, where I've said, whenever you make a financial decision, whenever you make a decision that may benefit your finances, like saving money and paying less of anything, it actually might be the opposite of what you would expect to have a benefit for credit. So let me put it this way. Whenever you make a decision that's good for your finances, it actually may not be good for your credit. When you make a decision that's good for your credit, it may actually not be good for your finances. And here's what I mean. If you're hoping to raise your credit score, if you hope to improve your credit, what do you need to do? Well, you need to get in debt. You need to show these lenders that you are in debt and that you are paying them interest, okay? That's probably one of the only ways, one of the main ways to increase and improve your credit. But doing this, you actually have to pay more because you got interest that you got to pay. Now, vice versa, you don't want to pay any interest. You don't want to get in debt, right? And you don't want to use any of the credit tools out there or any debt. Well, that actually is going to damage your credit because now it's showing that you're not using a credit. You're not establishing any relationship with any of these lenders. You're not giving any of these lenders an opportunity to get to know how your spending habits look like, what type of credit you're using, how much money you're using. So if you're not giving these lenders and institutions and credit bureaus any data, how are they going to assess the risk of that relationship with you? So whatever may be good for your finances isn't necessarily good for your credit. Whatever is good for your credit may not be necessarily good for your finances. Now, having said that, if you're saving money on interest, if you're paying down your mortgage, if you're paying down your debt, what do you think? What decision are you making there? Well, you're making a decision based on what benefits your finances. So of course you're going to see some damage or some negative consequences to your credit. And unfortunately, we can do our best to kind of balance it out, like not damaging to your credit and not necessarily damaging your finances. But if you're using all of your HELOC, let's say you use 50% of your HELOC, will that take a toll on your credit? Yes, it will. But are you saving more money on interest by taking more away from the mortgage that's subject to higher interest? Yes. So you can see here that you have to sort of make that sacrifice, and it's all about what is your end game? What is your goal? Is your goal to have this really nice, shiny credit score, perfect 800, 850? Or is it to actually use that credit to save money, to make money and to advance your financial cause? Okay, I always give this analogy. If you are a contractor, would you rather have a really, really shiny hammer and a drill, or would you like to use that hammer or a drill to actually make something and build something, right? So same thing with credit. Would you rather have perfect credit, or would you actually like to use that credit to do something with it and save money? So that's a goal decision. Like, it depends on what do you want to achieve. Okay, if you don't care about paying high interest and all you care about is making sure your credit stays good, then probably you shouldn't be using the strategy. You should just keep on paying your mortgage the way that it is, pay 2 to 3 times the amount of mortgage that you would normally with our strategy, but you're saving your credit. So again, it all depends on what your financial goals look like. Okay. This 2-day event, and you, Daniel, are going to event and talk at. What kinds of rates are at the rooms? Is it a complete 2-day event, or can I just do 1 day because I have to get back to work? Yeah, so Steve, you can go there just for Saturday. The Friday portion is the networking portion between, I believe, 5 to 9 p.m., where you guys can ask me questions, take pictures, and it's gonna be a meet and greet. So Friday, if you just want to do 1 night thing or 1 day thing, or if you don't want to stay at a hotel room, you can just come for Saturday and just leave after the event. So Saturday is the training portion. Friday is gonna be the meet and greet and networking portion. Which I believe both are equally important. But if you have time constraint, you can go for the Saturday and you'll be completely okay. So definitely come buy the tickets, and I think it's gonna be worth your time and your money. Definitely so. I think it's gonna be worth actually more than your time and money, because you're gonna actually walk away with some money-making strategies that you can implement right away. So it's actually worth more than your $99 that you'll pay for the general admission. Okay. Ephraim is saying, thank you for your well-organized information. What does your HELOC strategy includes and excludes? Stuff like closing costs and other add-on. One, I get once I get registered in your program. So luckily, the bank that we typically want to use doesn't have a closing cost. So we'll recommend and get you in contact with banks that don't have a closing cost, and they clearly understand our strategy and they know how to help you throughout that strategy. So that's what we can help you with once you sign up for our program. Okay. Steve Fernandez says, I talked to a lender. They said it's hard to get a loan as an investment house and rates are higher. But if I say it's a secondary home, it might work and rates are cheaper. Any thoughts? So, Steve, you want to be honest, right? Obviously, if you're going to use it for an investment property, tell them it's going to be for an investment property. The cost of lying to a financial institution, actually, it's a federal crime to lie to a financial institution. You can go and look it up. There are several different cases where people have been fined multi-million-dollar fines. Some people have actually gone to jail, 10-year sentencing, as I've seen, for lying to financial institutions. Little lies, such as how much, like, you know, when you get your credit card application, it says, hey, what is your annual gross income? I've seen people lie on the application and get sent to jail. And of course, it sounds like a no big deal thing, but the only reason, one of the big reasons why these people get sentencing, well, first of all, it's fraud to lie to a financial institution. But I think one of the big reasons why, you know, we see these court cases time and time again, it serves as an example. Like, we have to actually enforce, right, the law that says, hey, you can't lie to financial institutions. So we see time and time again where courts rule heavily against people that probably good people, right? But they straight up lie to their banks saying, hey, yeah, I make $500,000 a year when they only make $70,000 a year. And you see these people going to jail for 10 years for something that seems really minuscule. But court sentences that way because they want to make sure everyone's scared enough to not lie to the banks. So what I want to tell you guys is don't lie. Okay, it's not a good thing. Even if you get away with it, if you believe in God, God doesn't like liars, so it's not good. So don't lie, okay? Ephraim is asking, how much is your interest rate? So Ephraim, I am not a bank. I'm not a lender. I'm not a mortgage broker. I don't quote rates. I don't do that because I'm not a bank. So you're gonna have to talk to your bank. It's gonna heavily depend on your credit score. It's gonna heavily depend on your financial situation. So you may wanna connect directly with our people. In fact, I don't know if I'm allowed to give quotes based on law, and I don't have the licensing, or I don't have the license to tell you guys that, you know, such and such will qualify for certain interest rates. So I can't quote any rates, but contacting the lenders directly, they'll probably be a better help than I can, okay? I know that's probably the biggest mistake or misconception that we lead, and we don't want to mislead anybody in our channel, or we don't want to think or misrepresent anybody in our channel. We're not bankers. We're not a mortgage lender. We're not mortgage brokers. We're sort of your advisors, sort of like, I wouldn't even say advisors. We're on your side, right? We're kind of like your fan, where we want to help you be empowered with knowledge and education, so that when you go talk to these banks and lenders, you're sort of on the same level as they are, or perhaps you're smarter than them, so that you don't get tricked into bad situations. So we want to make sure. Yeah, Francisco is saying, quote of the day, God doesn't like liars. Exactly. So back to what I'm saying is that, we're educators, right? My job is to educate and teach you guys general concepts, financial concepts that are going to help you understand deeper into what sort of strategies and concepts that are out there that can get you at least one step farther ahead than the common public, okay? All right, so it is 11:52 a.m. This is where we usually cut our time. Guys, appreciate all of you guys asking questions and being on board. Next week, we're going to come back to some amazing Q&A and just kind of recap what we talked about today. Debt consolidation loans, not what you think it is. You may want to do some more research. There's a lot of trapdoors here, and interest rates don't tell the entire story. So if you guys have no idea what I'm talking about, definitely go and check out our strategy video. If you guys haven't already, go and subscribe to our channel, as well as click on like on this button. It really does help us continue to serve you guys, as well as putting out more content and information out there. So definitely go and subscribe, click like. If you have any other question, go ahead and comment down below. All right, thank you so much, guys. And until next week, I'll see you guys in another video. Take care.